2 days ago, the big news was that the US debt got downgraded again, this time by another credit rating agency known as Fitch, from AAA to AA rating. So how does this affect you as a stock investor and as a bond investor? And are there any possible negative repercussions that could come out of this? Let's find out more in this video. So first, a bit of background. US government debt, also known as US Treasuries, they are rated by three main rating agencies. The biggest rating agency, by the way, I own shares in this company, is known as Standard & Poor's, or S&P. The second biggest rating agency is Moody's, and the smallest rating agency is called Fitch. So they rate bonds of governments and of corporations from AAA rating to AA to single A to BBB, basically how safe the bonds are. Now, historically, US government debt or US Treasuries have a AAA rating. What happened back in 2011 was the market was shocked because for the first time, S&P downgraded the US debt from AAA to AA, and it remains at AA plus since then. Okay, but what happened was 2 days ago, Fitch decided to join S&P and say, we also think that the US government debt should be AA plus. So they announced that they're going to do a downgrade, and that's what's causing all the hoo-ha. Now, I often get asked this question, Adam, are you concerned that the US government debt is downgraded? And one of the reasons it's downgraded is because Fitch says that the country is just getting too much indebted, yeah? And now the US debt to GDP ratio is going to reach 118% in 2025. So again, people ask me, because most of my investments are in the US stock markets. So am I concerned about this ballooning government debt in the US? The answer is not at all. I've got zero concern for a few reasons. The first reason is understand that I don't invest in the US government debt. I don't, right? I invest in US stocks. Now, when you buy US stocks, you're buying shares of businesses. So I'm a part owner of Amazon, I'm a part owner of Meta, I'm a part owner of Microsoft. And these companies I choose have solid balance sheets. They are strong companies with little debt themselves. So theoretically, even if the US government got into trouble and they couldn't pay their debt, for example, which will never happen, but even if, I don't give a shit. Why? Because I don't own the US government debt. I'm owning great companies. So the important thing is that the individual companies that you invest in, like Microsoft or Amazon or Meta or Adobe, as long as these companies don't have high debt, the companies themselves have low debt and a lot of cash, who the hell cares? The only indirect repercussion is that if for whatever reason the US defaults on its debt, which is impossible, but let's say they do one day, what's the repercussion? The repercussion is that interest rates will go sky high, because if people feel that US debt is risky, they demand a higher interest rate to hold that debt. And that could cause interest rates to spike and cause companies a lot in order to borrow money. So it's going to be more difficult for companies to borrow money. So does that concern you as a stockholder? Yes, if you invest in companies that require a lot of debt financing, then you are screwed, right? But again, if you invest in companies that have solid balance sheet, that have got very little debt, then you don't give a shit. Okay, so that's the first thing. Now let's go to the second thing, which, will that ever happen? Will there ever be a fear of the US government not being able to pay off its debt? No. To me, the probability is near zero for a few reasons, and I've said this before in past videos. Number one, remember that US government debt is in US dollars, and the US government can print US dollars. Now, if a country owes money in a currency they can print, there's no problem. They can just keep printing money. Of course, doesn't sound very good, but that's the fact. That's number one. Number two, I've also shared before that if you look at the total government debt, you got to understand that 22% of the federal government debt is held by local governments. So in other words, it's like left pocket, right pocket. So who does the federal government owe money to? The local governments, right? And 52% of the rest of the government debt are held by domestic holders. In other words, Americans themselves. And 40% of that 52% is the Federal Reserve. Okay, so again, it's left pocket, right pocket. So in general, 74% of all government debt is held by Americans. Now, yes, US government debt has been rising and rising over the years, but is it really too high? Well, you have to compare the debt to the GDP ratio, because this tells you that they've got so much debt, but what's the GDP, which is the income of the country to pay back that debt? That's the figure you're looking at. And if you take a look at the US debt to GDP ratio, it is currently at 116%. And again, Fitch is saying that, but it's going to go to 118%. Now, is that very high? Well, it's all relative. Take a look at Japan. Now, Japan's stock market has been doing really well recently, right? Japan's debt to GDP ratio is 239%. It's a lot higher than the US. Singapore, the country I'm in, the debt to GDP ratio is 165%. It's higher than the US. But of course, Singapore is a bit of an outlier because Singapore has got a lot of assets, okay, that can easily pay back all the debt. So it's a net creditor nation. So in summary, am I worried about the US government debt losing its reputation as a safe haven, risk-free asset? Not at all. To me, it's still the safest asset you can ever buy, although the yields to me are very low, so I don't bother buying them. In fact, Warren Buffett was asked recently whether he was worried about Fitch's downgrade, and he said, no, not at all. In fact, he's putting his money where his mouth is. In fact, Buffett shared that Berkshire Hathaway, they are buying up to $10 billion worth of Treasury bills every week. So every week they're buying $10 billion worth of government bonds to earn interest on their cash, which they will later deploy into the stock market when they want to, right? At the same time, foreign holdings of US Treasuries continue to be on a steady uptrend. So does this mean that the downgrade of the US debt has no impact on the stock market, no impact on the bond markets? No, there is an impact. But the impact is a short-term impact and is purely psychological. It's purely emotional, which is something that you can take advantage of as a rational investor. So let's take a look at the last time this happened. This was back on 5th of August 2011. Now, that was the first time that S&P downgraded the US debt from AAA to AA+. Now, when it first happened, it came as a shock to people because it has never happened before. People never thought that the US could lose the AAA rating status. So, because of that shock, the stock market went down. How much did it go down? It actually went down. Now, this was the exact date of this announcement, 5th of August. So, the S&P 500 dropped 10.5% as a result of this downgrade. Now again, was it logical? No, it was purely emotional because nothing changed. US debt was just as safe, people were still buying it. In fact, here's the joke. The joke was that after the downgrade, what happened to US Treasury Use? US Treasury Use collapsed. Now what does that mean? When Treasury Use collapse, that means Treasury bond prices go up because bond prices move the inverse of yields, right? So why did bond prices go up? Because people were buying bonds. So that's the irony. When S&P said the debt is less safe, more people bought the debt, more people bought bonds, and by buying more bonds, the bond price went up and the yields went down. So that goes to show you how freaking illogical the market is. It's like something is worth less, let's buy more of it, right? Okay? Now, at the same time, the stock market went down by 10.5%. And like I said, that sell-off was purely irrational. It was totally psychological. And I remember that day. So I used it to buy a lot of stock. I said, this is a gift, all right? So whenever the market gives you this gift of buying stocks at discounts, you go grab it. And 6 months later, boom, the market was up 31%. So now that it's happened a second time in 2023, the market is now saying, hey, I've seen that movie before, okay? So people are asking, this time could the market also collapse another 10% because of this downgrade? Now, everything is possible, but I don't think so. Why? Because again, the market is not stupid. The market saw this before. This is nothing new. It's no longer a shock. And the market remembered that the last time it happened, it was a short-term drop and it went up again. Okay, so when the market watches the movie before, they are not so dumb to sell. Okay, they say, hold on, it's going to go up again, right? So that's the first thing. Now, the other interesting thing that's different this time is that when Fitch downgraded the debt, yes, the stock market dropped the last 2 days. But if you ask me, it is not the downgrade that caused the drop in stocks. No. I already told you guys the market was due for a pullback. I already told you guys that, right? Because of seasonality. That August and September tends to be seasonally bearish. And given the fact that the market has already gone up so much, wave up, it's bound to come down. You know, market makers have been itching for an excuse to push prices down, to shake out the weak holders. So when they got this downgrade news, it was a great excuse to push the market down. Make sense? So it's not the downgrade that so-called caused a sell-off, but the sell-off was going to happen anyway. But they're using the downgrade as an excuse to sell it off, to shake out the weak holders in the market before they push it up again towards the end of the year. Remember that the market is totally manipulated in the short term. It's totally manipulated. All right, whether it goes up or down, it's all manipulated. They just find reasons or news to justify the manipulation. Yeah. But what was interesting this time is that, remember, in 2011, when the debt was downgraded, the Treasury yields went down, right? But this time, Treasury yields went up. It's like, how come? It's the opposite, right? So why did Treasury yields go up? Now remember, when Treasury yields go up, is because Treasury bond prices go down. It's the opposite, right? Let me write this down. When bond prices go down, and you can look at the bond prices by looking at the ETF, like you look at the TLT ETF, that tracks the 10 to 20-year Treasury bond. The TLT price collapsed and the yields went up. Yeah. So is there any relationship? Is it because of the downgrade that caused people to now sell bonds, causing bonds to go down and the yields to go up? I don't think so. I don't think that's the reason. Because remember that back in 2011, the downgrade did not cause a sell-off in bonds. It caused the buying of bonds. So this sell-off in the bond market and the rise in yields is caused by something else. So the first reason why Treasury bond prices are falling and Treasury yields are rising is because of stronger than expected economic data. GDP Q2 was better than expected. Very strong employment data and very strong earnings, especially from cyclical companies like construction companies like Caterpillar. So ADP just announced about 2 days ago that private payrolls gained the most since July. Employment rose 296,000 in April, topping all estimates. So job growth is extremely strong. At the same time, Caterpillar reported their sales surge double digit as there's a construction boom. So why is it when the economy is very strong, bond prices fall and yields rise? This is economics 101. Remember that when investors see a growing economy, they tend to sell bonds and use the money to buy stocks. So by doing that, selling bonds, less demand for bonds, bond prices falls, yields rise. That's the first reason. Now, so is that a good thing? It's a good thing, right? Strong economy, bond prices go down, yields go up. That's a good thing. Second reason why bond prices are falling is because there's been a big supply of bonds recently by the US Treasury. So the US Treasury has recently been selling more bonds than usual in order to fund a bigger government deficit. So by selling more bonds, what happens? Supply increases, bond prices fall, yields rise. So it's a combination of a strong economy and more Treasury sales that are causing Treasury yields to rise. So you can see the impact on Treasury yields on this chart. So you can see that the last few days, Treasury yields, this is the 10-year yield futures, it has spiked up and it now broke above the recent resistance over here, and it's now at 4.1 0.15%. So yields have gone up a lot. And conversely, as yields go up, what happened to bond prices? They collapse. That's right. So take a look at the TLT, the 20-year Treasury Bond ETF. It just broke this support level over here and is going down to the next level of support and even that low that we saw last year. So are very high Treasury yields good or bad? Well, like everything else, there's good and bad. So what's the bad thing? The bad thing is that when Treasury yields go up, mortgage rates go up, which means now it's more difficult for people to buy houses. So this could reduce the demand for housing in the US. And this could lead to a collapse of housing prices. But then you could also argue that there's no supply in housing. There's a limited amount of supply in housing, and people who have houses are not selling because they bought them at much lower mortgage rates. And that's why home prices are still going up despite Treasury yields going up and mortgage rates going up. Okay. The second bad thing that could come out of this is that, now remember what happened the last time Treasury yields went up so much. We had a lot of bank failures. Remember that? Silicon Valley Bank collapsed. Signature Bank collapsed because many of these regional banks, they hold treasuries. They hold all these treasuries as assets. So when the treasury prices collapse, when they fall, the bank assets go down, and if it goes down too much, the bank could become insolvent and it could lead to more bank failures. So could that happen? It is possible. It is possible that this could happen. So this is something bad that could come out of it. Another concern would be, of course, is as Treasury yields rise, that means the cost of borrowing goes up. So for companies that require a lot of debt to run their business, it's now more difficult for them to borrow money. They have to now pay high interest rates on their debt. And that could cause companies that are highly leveraged to also collapse. So that's all the bad things. Now, what's the good thing? The good thing is that a higher 10-year Treasury yield is an indication of a stronger economy. That's why people are selling off bonds and going to equities, because of a strong economy. And in a way, it's also good because it is beginning to uninvert the yield curve. Now, remember that for many, many months, a lot of the bears have been saying, oh, the yield curve is inverted, that's a bad thing, right? Now, what does yield curve inversion mean? It means that the yield or the interest rates on short-term debt, like the 3 months, is higher than the yield on long-term debt. So right now, the Treasury yield curve is inverted. Inverted yield curve, people say, oh, bad recession, right? So what's happening now is that the short yield, which is the 3-month yield, this is affected by the Fed funds rate, the Federal Reserve. Now, the Fed is now saying that they are not going to raise much anymore. So people believe that the Fed's going to hold or even cut in a while, which I believe, all right? So in other words, the short end of the curve should be more or less fixed for now. So to uninvert the yield curve, what has to happen? That's right. The long-term bond, which is the 10-year and the 30-year, this has to go up, right? So if this goes up, the yield curve will then uninvert and we have got a normal yield curve, which is healthy for the economy. So by the 10-year yield now going up, right, and this staying there, it is actually causing an uninversion of a yield curve. So isn't that good? So remember that whatever happens, there's always good and bad to it. But bottom line, how does this affect us as investors? How can we use this knowledge to make better investment decisions? Let's first turn to the stock market. Now, always remember, I keep saying this in every video, no one can predict the short-term direction of the stock market because anything can happen and there are just too many moving parts. All we got to do is to invest in high-quality companies or the index and look at probabilities. So if you look at the S&P 500, I've already said many times that we seasonally, August and September and the early part of October tends to be seasonally weak, and especially after a strong run, wave up. In the last few months, we need to expect a pullback or maybe a small correction, which is healthy for the market to shake out the weak holders before the market surges to a strong finish by the end of the year. So again, the downgrade by Fitch, I think, was a good excuse for market makers to push the price down, because I believe that in the short term, all price movement is all manipulated by algos, by market makers, and we just have to take advantage of these manipulations instead of being scared by them. So where are we right now? So since we made a high on the S&P 500, you can see the market has come off right now. It has retraced below the 20 moving average. So in this pullback, you can see we kind of like found support above the 20, found support above the 20. So we may get a bigger pullback in this area over here, given that we're now in August. So how deep will the pullback go? Again, we can't predict, but we can make some intelligent guesses. So if I were to make a guess, I would say that the first level of support I'm looking at would probably be here, because this was a previous swing high, and this coincides with the 40 EMA. So we could look at this as the next level of support if the market continues to trade down. The next level of support, if that breaks, would then probably be the 50 moving average over here. All right, so from the top to the bottom of this retracement will be roughly close to a 5% pullback, which would be a very healthy pullback within this bigger bull market. So I believe that during this pullback, this correction in stock prices are great opportunities to add shares, because the economy is staying strong, inflation is coming down, and company earnings are coming in better than expected. Not just tech earnings, but even industrial earnings as well. As I mentioned, Caterpillar. Yesterday, one of my biggest positions, Amazon, announced great earnings, which I expected. I told you guys that Amazon was very undervalued, that I expect Amazon's share price to double easily from current levels, because Amazon's earnings have in the last few years been artificially suppressed. Their free cash flow turned negative on purpose because of their high capex spending to widen their moat, to build more distribution centers, and to build more data centers for their cloud business. So now that Amazon has ended their capex cycle, you can expect that their earnings and free cash flow to explode higher. And again, for the share price to easily double from here, because Amazon is very, very undervalued. And I told you guys that there are certain companies like Amazon, you can't look at the PE ratio, because if you look at the PE ratio, it looks very high. You can't, because PE is very distorted for companies like Amazon. You have to look at other metrics and value it differently. So like I said, Amazon is one of my largest positions in my portfolio. Amazon is in fact right now the second largest position. And they just announced earnings yesterday. Meta is still my biggest position after it's up over 100% this year. And recently, Alphabet also great earnings. Microsoft earnings was good as well, but because the price already went up so much, the price did come down after earnings were announced. Palantir going to announce earnings soon, so we'll see how that goes. Booking.com, which is also one of my bigger positions, great earnings, and Mercado Libre, which is one of my bigger positions, also announced great earnings. So far, all the companies I own, they have all surpassed their earnings expectations. Now, besides the equity markets, do I see opportunities in the bond market, given that the TLT, for example, has fallen off a cliff? Do I see a possible scenario to buy this ETF? Now, I heard recently that Bill Ackman has been shorting the 30-year treasuries. And you can bet, now my guess is when these hedge fund managers tell you that they're shorting it, they already shorted it quite a while ago. And usually by the time they tell you they're shorting it, they're probably going to close their position, which means it probably may reverse the other way, right? Just a guess. So again, if you look at the TLT, you can see that I was pretty surprised myself that it broke this level of support. And now it's coming down, and you'll probably retest either this swing low or this all-time low. So I'm watching these levels, okay? So if it hits this level and I see a strong reversal pattern, like a double bottom, and I see a bullish candlestick pattern, I may take a long trade over here as more of a swing trade. Or if it breaks this support, then I'll look at the last all-time low to see if there's a reversal trade at that area. Now, those of you who are in my stock trading community, you know that I sent a buy alert to buy TLT right here, right? We bought it there and we took profit there. We got a 2-hour win, right? We bought it there, we had a stop loss there, we took profit, and we were out before this collapse because we could see that once it went up, it couldn't break that 50 moving average resistance. It couldn't break it, and it reversed back down again. And that's why the way I trade the markets and the way my students trade is we never trade based on predictions. We never trade based on news. We trade based on price action. Understand support, resistance, candlestick patterns, having a good risk-reward ratio. And that's how you trade profitably, right? And of course, not every trade you win. We've got winning trades and losing trades. But the difference is that we win a lot more than we lose. And when we lose less. We win a lot more. All comes down to managing your risk to reward ratio and your position sizing. And that's the trading part of it. Yeah. For investing, we just buy great companies and we just hold it through the ups and downs. Hope it's been useful, and I'll see you guys in the next video. In the meantime, may the markets be with you. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.